Hello folks, this is Richard Paul from Richard W. Paul & Associates with an educational economic update for December 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in November and so far in December. I'll also provide insight into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Unlike December, November closed on a strong note despite a month of volatility. Details like trade disputes, oil supply, dropping prices caused markets to fluctuate throughout the month. By month's end, however, investors showed optimism as the markets rebounded. We saw positive gains in November, only to give it all back and then some after the first half of December. It'll be questionable whether a Christmas rally can bring us back to positive territory by year's end. One reason for November's upturn was the annual G20 summit in Buenos Aires and the anticipated meeting between President Trump and China's President Xi. Ahead of their session, the Dow rallied nearly 200 points. The leaders planned to meet to discuss cooling down the tense trade environment in hopes of finding a consensus between the two countries. In addition, President Trump and Mexican President Enrique Nieto and Canadian Prime Minister Justin Trudeau signed the U.S.-Mexico-Canada agreement, which still must pass Congress. While some are hopeful that the North American Free Trade Agreement replacement will resolve trade disputes, others do remain skeptical. G20 news also impacted oil, which had its largest monthly decline in 10 years. Continuing from October, oil prices fell 22% throughout November on fears of international surplus. Updates on interest rate hikes also helped November finish on the upswing. On Wednesday, November 28th, Federal Reserve Chairman Jerome Powell remarked that interest rates are close to the current neutral range. They're looking for that 2.5% to 3.5% sweet spot. His comments seem to suggest that the Fed may throttle back interest rate hikes for next year after the 0.25% increase in December, lessening concerns of slipping into a recession. U.S. factory production climbed higher than expected, with the manufacturing index beating expectations at 59.3. Any number above 50 registers growth in the industry. Still, construction spending dipped for the third month in a row. But consumer confidence does remain high, though it slipped in November after an 18-year peak. Further, we have solid job growth in November. The development keeps the unemployment rate hovering near 3.7%, the lowest in 48 years. Also, the revised third quarter domestic product numbers came in at a 3.5% increase, with corporate profits reaching a 6-year high. Together, these healthy indicators suggest that the economy is on the right track as we close out 2018. As always, we encourage you to focus on the fundamentals. That's it for this month's Educational Economic Update. We wish you a very Merry Christmas and a Happy New Year. Now, please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 248-305-9911. We'd be happy to talk to you.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. Past performance does not guarantee future results. Richard W. Paul & Associates is a registered investment advisor in the state of Michigan. Midwest Financial Consultants is an insurance services firm.